Why do the traders you follow guess where the price will go so easily? Of course, they have years of experience behind them, but that's not the only reason. To have clear expectations on where the price will go, there is a clear algorithm. Starting from defining the context and identifying the price target, all the way to entering a position. Every step is not random. It is planned out long before entering a trade. In this video, I will reveal 3 such setups, fully ready for intraday trading. Here I will be talking about Forex, indices, and crypto, and each type of asset will have its own specifics. To determine a target for the price, I need to see not only a formation that is highly likely to draw the price, but also understand the context in which it formed. A target without context is just as useless as context without a target. You need the target you want to form under the conditions you need. Only in this scenario will you have an understanding of the potential future price movement. It is impossible to just glance at the chart at any given time and always clearly understand where the price will go. Let's start by defining what price targets we have in general. Then we'll break down the context in which I am interested in working with them. And finally, what my point of interest will be based on all of this. The targets I consider for myself are, first of all, session liquidity, compression, equal lows or equal highs, consolidation boundaries, and an open gap. There are many types here. We will break them down later in the video. As I said earlier, outside of context, targets mean nothing to me. I am interested in working with targets in the context of the AMD model, in the context of session models, or in the context of structure. At the same time, to have clear expectations for price movement, it's not enough to only have a target and the right context. You also need a point of interest, because what is the use of the price reaching your target if you didn't enter a position? Summary. In order to have clear expectations for price movement, we need a potential price target, a point of interest from which the move to the target is expected, and the context we need in which this situation will appear. Let's go step by step and first break down all the elements separately, after which we will put them all together so you have a clear picture. Let's start the breakdown of targets with compression. Compression is when the price is squeezed within a tight range. It is important to us that during this time the price does not make sharp movements, doesn't leave imbalances, doesn't make manipulations, meaning it doesn't sweep previous lows or highs. This formation is interesting to me both on the daily time frame, although here it's more for defining the overall higher time frame context rather than for a specific situation, and on the 1 hour and 15-minute time frames for intraday analysis. I don't go any lower. My approach doesn't require it. Let's immediately look at equal lows and equal highs. I think everyone knows perfectly well what this is, but I believe it is necessary to point out the nuances of how I apply this target. First, I am interested in time frames from the 15-minute and up. Essentially, I look at the 15M and 1 hour time frames. These will be targets strictly for intraday trading. To define higher time frame targets, I look at time frames no lower than the daily. Second, I don't need a perfect line where the price aligns pip to pip. A slight sweep is not critical for me, and it will still remain a good price target. Another formation that creates an excellent price target is a consolidation. Again, it doesn't matter which one we are talking about. An intraday consolidation, a consolidation that lasts a couple of days or a couple of weeks, or even several months. The principle will be the same. The upper and lower boundaries of a consolidation represent an excellent target for the price, which I will trade towards in the right context, but more on that a little later. The fourth target is session liquidity, meaning a session boundary that hasn't been swept yet. For example, the boundaries of the Asian range are exactly session liquidity. The high and low of the London session will also be session liquidity, just like the high and low of the New York session. However, not all session liquidity is interesting to me. It will act as my target only if I see one of my Asian session or London session models. In other cases, session liquidity will not interest me. I'll say a few words about indices. They have their own specifics, and their session models are different. At the moment, I have come to the conclusion that I am most comfortable trading during New York after the start of regular trading hours. I mark out the range the price leaves starting from the Asian session up to the open of regular trading hours. In the right context, which we will discuss later, such a range gives me a potential entry point after a manipulation, and a target in the form of session liquidity along with compression and range liquidity. As for crypto, I do not consider it for intraday trading at the moment. There are no sessions as such here, but there are more active and less active times. I would consider the times of the Asian and New York sessions to be the most active. And the last target I use is a gap, meaning a break in price. There are quite a few types of gaps, ranging from a news gap, daily open gap, weekly open gap, all the way to the gap created between the close and open of regular trading hours. Despite this variety, to me it is the exact same target. It doesn't matter much to me why it appeared or what it's called. What matters to me is the context in which it exists. Now let's talk about the context in which I want to trade towards these targets. But I want you to clearly understand, everyone's view of the chart will inherently be their own. Whether to open a position towards a target or not is something everyone will decide for themselves based on their understanding of the situation. I am talking specifically about those setups through which I determine the possible price movement scenarios in the moment, when the target I need and the entry point form within these setups. Thereby, they define a long or short directional bias for me in a specific situation. And I'll say this in advance, these are not patterns. Don't reduce everything to simple pictures. These are merely my conditions under which I am ready to start considering a situation for a trade. So, in order for me to even think about opening a position towards the designated targets, they must appear under certain conditions. This could be an AMD model, both intraday and on a higher time frame. As I said earlier, the logic of working with AMD will be exactly the same across different time frames. In this case, after a manipulation on one side of the consolidation, I will be interested in its opposite boundary, especially if there is also compression or equal lows or equal highs near that opposite boundary. Session models also help define the context. When you see one of the price targets, and at the same time a session model implies movement in that direction, this is another situation where I will trade towards that target, since session models fundamentally shape my daily bias. I want to point out that price targets very often intersect with session liquidity. For example, when compression is created during Asia or London, or when a session pool is located nearby or acts as a consolidation boundary. Basically, my session models were built on the intersection of these targets and the standard behavior variations of a specific session. Another scenario where I will have a contextual bias is movement within market structure. In this case, I consider two options. The first is trading in the continuation of the structure after a pullback, when I see the formation of a target for the price to move in the structural continuation. The second option is when we sweep a key liquidity pool on a higher time frame, and we might get a pullback in the structural move. I consider weekly fractals as key pools. They don't appear very often, and sweeping them frequently provides a reaction. Sometimes this will actually be the endpoint for the structural move on a higher time frame. And due to the significance of these pools, sweeping them is another situation where I will consider a move towards the target. These are my main steps for building the context for a specific situation. What have we arrived at by this point in the video? We know what will act as our target and under what conditions. This means that in these situations, I will already have expectations for price movement. The question is how to execute them. So which lower time frame confirmation model should you choose? And what risk to reward ratio should you select? As for the risk to reward ratio, there is no best ratio. It doesn't really matter which one you choose. The results over the long run will be either identical or very close to it. The larger the sample size taken for backtesting, the more similar the results will be. They constantly try to drill into your head that a high risk to reward ratio is mandatory and that entering a trade only makes sense with one. It seems like the higher the better, but unfortunately, in reality, the more you increase your risk reward, the almost proportionally lower your win rate will be. Speaking of confirmation models, you have two options. The first is to look for lower time frame confirmation after the price reaches your point of interest. Usually, this is done through a break of a 3-minute fractal, confirmation via a 5-minute imbalance, or additional structural confirmation on the 1-minute time frame. There are simply a million options here, but it is important to understand that there is no best one. Otherwise, everyone would only trade that. The second option is simply trading directly from the point of interest with a fixed risk reward. Roughly speaking, the price reaches your point of interest and you enter the position without confirmation. You stretch your take profit to the target and widen the stop loss until you get the desired ratio. It might seem like the second option is simpler and therefore worse, but that's not true. First, you definitely won't miss your setup. It's easy to get distracted and miss an entry. Second, you will have a wider stop loss, which means significantly lower commission costs and slippage losses. And third, you will spend much less of your time, as you don't need to wait for a confirmation model for hours. So how do you decide what suits you? Speaking of the AMD model, where your initial point of interest is the consolidation boundary that will be swept first. Session models, where the point of interest will be a certain session pool. And structure, where the point of interest will be the entire buy to sell or sell to buy zone. You essentially have three possible scenarios. a move to the target immediately after reaching your point of interest, or reaching the target after a more prolonged manipulation, for example, a secondary liquidity sweep in the AMD model, or a prolonged London manipulation, or reaching the target after a deeper pullback into premium or discount. And the third scenario is the failure to sweep your desired target after reaching the point of interest, meaning the idea fails to play out. You must consider all possible scenarios and have a plan for each of them. Without backtesting, you cannot know which confirmation model and risk to reward ratio will be the best option for you. I see 3 options that you can test for yourself personally and choose the one you are most comfortable working with. Simpler doesn't mean worse, and more complex doesn't mean better. Just choose what is most comfortable for you. So, in order to consider a situation for intraday trading, I must see the right context, the right target for the price, and execute the entry into the position using my chosen entry model. Out of all assets, I only apply these setups on the Euro-dollar, British pound, and gold. This is exactly the framework I use to analyze local intraday situations. This is far from the entire top-down analysis algorithm. I will fully reveal that in another video. At the end of the day, this is just my approach. Use it if you want, or don't.